Right, so welcome back to QuickBooks Online. We are going to be diving into chapter 11, which is going to be the very last chapter of this entire QuickBooks class. Okay, so chapter 11 is going to be the adjustment, the adjustments and the year-end procedures. So this is going to be us finally wrapping up our books and closing up the book so we can go ahead and move on and process for the next accounting period, accounting cycle, whatever, you choose it to be, right? Now, in this case, everything has to happen ahead of time, right? Because we're looking at making adjustments which typically happen at the end of a given accounting period, okay? So whether it's daily, whether it's weekly, whether it's monthly, whether it's yearly, whatever whatever period or time frame that you choose to close your books out, meaning you're wrapping up the books for a certain accounting period, right? Whether you're going to either do your quarterly reports, your annual reports, at the end of the day, you have to make your adjustments at the end of the year because you have to file for taxes, right? Every year, by the end of the year, you have to file taxes no matter what. So your given accounting period has to be within 12 consecutive months. So usually, typically, these adjustments would typically happen at the end of the year. Depending on your fiscal year, whether you're January to December, so calendar year, you would close your books at December, or if you choose a actual fiscal year, it will be the very last day of the 12th month of the very last day. So in this case, if you are, for example, fiscal year is from July 1st all the way to June 30th, then June 30th would be the last day that you'll do your adjustments, okay? Well, that's just looking at an example of a yearly accounting period. So that is what I'm going to talk about. So making your entries. Now, adjustment entries are going to be determined based on your journal entries, okay? So here, if you take a look in your book here, there are a few adjustment entries that are necessary to complete. Okay, so for instance, you would use a journal entry to either recategorize any transactions from class to another class. Okay, so if you make any mistakes or if you forget to categorize certain classes, you're able to do a journal on that. You can also recategorize transactions from one account to another, right? Because with a journal entry, you're basically adjusting for right, the chart of accounts, anything that's on the chart of accounts. And then, of course, you can also record non-cash expenses such as depreciation. So what is depreciation? Depreciation comes with when you purchase fixed assets, right? And you need to find some kind of way to measure that you used that fixed asset. And the way that we understand it is through depreciation, right? Because when we purchase our fixed assets, they do not retain its value over time. But due to the historical cost principle, which GAAP governs, right? If you remember GAAP from chapter 1, right? We talked about that GAAP is the generally accepted accounting principles that governs all accounting. So in this case, they tell us that when you purchase your fixed asset, it never changes value in your books. But how do we represent that differently? Well, we do that through depreciation, okay? And of course, other ones are going to be if you have to do an owner's draw. So when you close out the books, you do need to do your owner's draw. And of course, any adjustments required for tax purposes. Okay. So in this case, let's go ahead and take a look at an example of our first journal entry we're going to do here, where we are going to recategorize a certain transactions that we forgot to classify. So in this case right here, we're going to go ahead and run our profit and loss by class and determine that non-specific list or non-specified list, or in this case, a something that wasn't classified. So in this case, let's go ahead and run reports. And we're going to do profit and loss by class, which we said was a business management. So profit and loss by class. Here it is. Okay. Now in this case, right, you want to make sure that you have it toggled however you are. In this case, let's just do all dates and refresh here. So once I do that, then it's going to show me what my unclassified lists are. So in this case, I got three columns right now for administration or administrative. I got my my overhead account, my store account, and here says non-specified. We have a few accounts that are non-specified, so let's go ahead and see. So the first one we have here is discounts group, or discounts given. And then we have right here shipping costs. So in this case, these two categories, these two items on our transaction list have yet to be classified. So how do we go ahead and do a journal entry to go ahead and categorize them into specific classes? So in this case, what we're going to do here is we're going to do a new journal entry for adjustment entry number 5 here for the December 31st date. And we're going to go ahead and put in our entry that the first one is going to be discounts given. Okay. So this is where you're going to have to need to understand this key feature is how does the debit and credit system work? Right now, I am told that right now that I have a negative $115 and a positive $32. Okay, so what I need to do here is I need to transfer that negative discounts given from and classify it as one of the, whether it was a store location or store class, or whether it's an overhead class. Okay, we're going to go ahead and transfer that over right now. So we have to understand that this is a negative number, then we have to understand how does this affect my books. Okay, so we have to go ahead and understand that one. So we're going to be needing to use our accounting model to go ahead and determine whether I need to debit my discounts given or credit my discounts given. Okay, so this is where you do need to know the accounting behind the scenes, or have the accounting background to be able to determine the debit and credit system. So that's why it's very important that even though you don't need to have an accounting background to be able to use QuickBooks, this is the section where you will be needing it. So it's primarily for the accountant section, so they are the ones that's going to be knowing more to how to adjust and to recategorize certain transactions. So in this case, plus new journal entry, let's go ahead and fill in our section here that we can go ahead and do the rest. So in this case, we said for December 31st, okay? Or in this case, you could also do at the end of the month of, in this case, let's just do November, just in case. Actually, no, I'll do that one. We said journal entry for 05, so it already put that in there for me. So the first thing I need to do is determine, right? Right now, my discounts given is a negative, and in this case, discounts given actually affects your sales, right? It decreases the value of your sales. So right now, it is considered a debit balance right now, okay? Now, that was just my profit and loss right there. If I can't figure it out on my own, I can always go and run a general ledger a general ledger account, so then I can kind of figure that out myself, right? If I do a ledger account report, I can determine right now what my current debit and credit is. Okay, so in this case, I'm not gonna do it, but you could do that. Remember, I already showed you from the previous one what the general ledger accounts do. It gives you the exact where it is, right? Is it on the debit side or is it on the credit side? Or you could run your trial balance. Okay. Now in this case right here, right, we're going to go ahead and put discounts given because that's the first category that I'm trying to recategorize right now. So discounts given. So here you go, discounts given. And then my second one is going to also be another discounts given. Okay, because I am recategorizing this like that, okay? So I need to figure out how does my debit and credit system work. In this case is what you're going to do. Now that I have my first one, discounts given, in order to move it from one class to another, I'm going to go ahead and classify that it's going to be a debit balance, right? We said that discounts given affects your sales. So in this case, it's going to be needed to be a debit balance. In this case, I'm going to put for 115 and it's going to be classed to the store. Okay? And then from there, because right now it's currently in my debit balance right now, right? I also have to credit the discounts given by 115 to the non-categorized one, right? So in this case, I'm going to debit 115, right? Because it holds a debit balance. And this one's going to be based on store location. Now, if you remember the exact store location that you gave this discount at, then that's where you're going to go ahead and also plug in the location. Now, in this case, I'm not going to do locations. I'm just going to do just classifying the store, okay? And then I'm going to credit the 115. In this case, we don't have a classification, right, because it's non-specified, right? Excuse me. It's non-specified right now. So in this case, I don't need to put any specifications. Excuse me. All right. And then you could choose whether to either go ahead and save this entry here, or you could go ahead and also do your second entry in there, right in there, since you're going to adjust them anyways for shipping and income. Okay, so shipping and income is an expense that is going to be is an expense, right? Expenses are normally debited as well. So in this case, what you're going to do is, because it is an expense, we're going to credit this. We're gonna debit the balance and we're gonna credit it for $32, and then we're gonna assign it to the Walnut Creek. Okay. So in this case, shipping cost. Let's see, I think it was shipping, freight, and delivery. Okay. And we said it was for $32. I actually don't remember which account specifically this one is, so I'm going to actually double verify before I go ahead and continue this one. Okay, so I'm going to go ahead and just go ahead and validate that one first. So files, save and close. Okay. So then here, right, if I refresh this, it should classify this. Let's do it again. All dates. Refresh. Okay, so here, like I said, it now has reclassified it to the store for that negative 115. So that's what I mean by recategorizing it. So this one is going to be for shipping income. Okay, so that's where I needed to make sure. So shipping income for $32. So I could go ahead and do another journal entry, or if you are trying to fix that previous journal entry, you can be able to go to your transaction list to locate that transaction and be able to edit that transaction that way. But in this case, it should be fine to just create another journal entry. There's no problem there. Okay. So in this case, shipping income, right? Same date, 6. So this is shipping income. So shipping income, right? Since it's an income, it has a normal credit balance since it goes towards your generated income. So in this case, since it has a normal credit balance, that's why in order to get rid of it, I have to debit it, but then I have to credit it back again to report it as generated income. So shipping income, right, we said was for $32. And because we're getting rid of it for the debit here, right, that means I'm not going to classify it. But because I'm going to recredit it again for that $32, I'm now going to classify this as the store location. And I believe it says I'm going to put it as Walnut Creek. Okay, so store to the Walnut Creek location. Okay, and then I'm going to go ahead and click Save and Close. Yes. Okay, and that should, if I refresh my page here, it should create that $32 into the correct spot. Let's see. Yep, $32 in the correct spot. Okay. And that's how you recategorize your transactions. All right. Okay. All right. Now, I'm going to also teach you how to do a $0 check. Now, the difference between a $0 check and a journal entry is journal entries are only made to recategorize from account to an account. $0 checks allows you to transfer information from products and services lists. Now remember, products and services are what can only be used on sales receipts and purchase forms, right? But they are attached to accounts. So for a journal entry, you only get to recategorize only accounts. That's why that's the key important difference here is if you're trying to recategorize from one account to another, you only can use the journal entry. But the $0 check allows you to move from either account to an account, and it can allow you to move from item to item. Okay, so that's the huge difference here. So in this case, we're gonna go ahead and do a $0 check here for a for the one of the cameras. We're gonna go ahead and take a broken camera. We're gonna refurbish it and add some fixtures to it. And once we do it, then we're going to transfer this into a new account. All right, so let's take a look at this one. So when we go ahead and do a $0 check, you're able to do either or, whether you want to actually write a check or not. But here's what's the difference here. You're going to code it to an adjustment entry, okay? So that's the person that you're going to be making the account to. And again, it's going to be, again, to the clearing agency, okay? Okay. So not checking. This is not, we're not going to spend money here, like actual physical money. So that's why it's very clear that you do make this extra quick adds into your account. So let's go ahead and get that in there first before we go ahead and continue on, okay? So once again, we're going to go to our $0 entry here. So by going to check, okay? So we're going to code this for April 1st, 2022. Okay, so remember the person we're going to pay is going to be called the adjustment. Okay? We're going to make it pay to adjustments. Okay? Inventory adjustments. So inventory. So I'm going to quick add. An inventory adjustment. Okay, and then I'm going to go ahead and click save. Okay, and I'm going to code this to clearing. Okay, to the account called clearing, right? Because we're not going to actually spend actual money here. Okay, so I'm going to go ahead and create and quick add a bank account called clearing. Okay. So there you go. I created the bank account clearing. Date once again is going to be April 1st, and it's going to be check number adjustment number 1. Okay. It's going to be for the Walnut Creek location for the store. So again, we're going to have this to April 1st. Okay. And then we said adjustment 1. Location, Walnut Creek. So in this case, maybe somebody brought in the broken camera from Walnut Creek location. So now I'm going to go ahead and repair it. So this allows you to give you a combination between categories, which is your accounts, and it also gives you a combination between the items as well. Okay? So in this case, our goal here is to ensure that this check is written out for the amount of $0. Okay? So how do I do this? So let's go ahead and take a look at the entries that we have to make here. We need to first enter in our first category, which is going to be the cost of goods sold, supplies, and materials, okay? And we're going to go ahead and put in parts to repair camera for negative $75, okay? Hence, the key here is negative $75. That means you spent money here, okay? And then, of course, you're going to code it to the expense account to cost of goods sold for shipping, okay? For overnight shipping, which is going to cost you also a negative $30. Okay, so in this case, we're taking the camera out from the cost of goods sold and we're going to put it into the category. So in this case, category here we said was cost of goods sold, supplies, and materials. So I'm going to put supplies. So this is, remember, this is our cost of goods sold supplies. That means we're undoing our, that we sold the item here. So here, cost of supplies and materials, description. Here is parts to repair camera. For the amount of negative $75, okay? So remember that class is store, right? This is from the Walnut Creek location. And we're also going to do cost of goods sold shipping. So I'm going to do shipping, freight, and delivery here, which is a cost of goods sold. And once again, we're going to go ahead and put shipping cost, right, to bring back the camera for $30, or for us to ship it out, to repair it, to store. Okay? So right now, I'm at a negative $105. Okay? And what I'm going to do now is, those are the extra costs, right? So then now I need to go ahead and put in my products and services. And I'm going to take that SR32 camera, one of them, minus one of them, for that $450. And then I'm going to put it into the SR32 refurbished. So you may have to add that in there, quick add that account in there, or sorry, this item in there, to go ahead for the full $555. Okay? So in this case, that's exactly what I'm going to do. I'm going to remove one of the good cameras and remove it into a refurbished camera. So that's where I'm going to go to items. So again, this product here is the camera. So the camera SR32, right? We're going to do a -1 quantity because we are removing one of the good products, okay? And then we're going to move it into the camera SR32 refurbished. So you may want to quick add that. There you go. It was an inventory item, but I'm going to call this camera SR32 refurbished. Okay. I'll put all that information in later, so you can always quick add whenever you feel like it. So in this case, I don't have any as of the date, January. Oh, went way too far. So as of January 1st, 2022, reorder point, I'm just going to say the 2. Okay. And then let's see, what else do I need to fill in? Category, this is going to be products. Okay. Class is going to be store, because you sell the refurbished ones at the store. Okay, and that should be good enough. Let's see. There you go. So there you go. Now I have the refurbished camera in here. So there you go. And now I'm going to remove the good one into the refurbished one. Okay, for one of them. and it's going to be for the total of $555. Okay? So therefore, overall amount should be 0. Okay? That's the goal, right? Because we removed one of the cameras for $450. We're going to add it to my refurbished camera, including the shipment for the part as well as the part itself. Okay, so the part cost me $75, and to ship that part out cost me $30. That's $100 right there, or $105, and I'm going to add that into my refurbished camera as part of fixtures. So then now that refurbished camera is $555. And I'm going to code it both to store. Okay. Okay, sorry, my computer is definitely reacting very slow. Okay, there you go, and save and close. So that is the goal of using a $0 check. It doesn't involve with money at all. All I'm adding here is moving from one item from one account to another account. That's all I am doing there. Okay? And that's the $0 check. Okay? Let's see. Okay. Let's see if we can get through depreciation. So, as I've mentioned earlier, right, when you make purchases of fixed assets, right? So in this case, I purchased that truck. If you guys remember from chapter 4, right? We purchased the truck, the cargo van, okay? Because I used the cargo van, okay, for for a certain amount of time, right? That is exactly what we're going to be doing here. Is we're going to represent, well, if we bought the cargo van back then for $30,000, right? Back in January, right? We have to find a way to represent that we use the cargo van. But here's the thing, like I mentioned earlier, right? Due to the historical cost value, we cannot just devalue our fixed assets just because. But in this case, when we're looking in realistic terms, right? Because we buy the cargo van, right? We're going to be using it. So how do we represent that we use it? And that would be through depreciation, which is considered a non-cash transaction. Because you've already spent the money to purchase the van, right? You're not going to actually spend money to depreciate or to represent that you use it. But we know for a fact that when we buy our van and we drive it off the parking lot, right? If we were to give it back to the original dealership, they're going to dock us money because it's lost its worth in value, right? So when you run it through an appraisal, it says that, oh, you ran this car for X amount of miles, therefore it's no longer worth $30,000, right? Now, of course, if that's the case, then where does the money go? And that's where exactly what we're doing here is we're representing a way to devalue it, right? Hence the word depreciation, right? You're decreasing value in a fixed asset. But in this case, we can't just code it directly to the asset itself. We have to create what's called an accumulated depreciation account. And of course, it's going to be coded to our depreciation expense. Now, if you remember when we purchased the cargo van, right, we purchased it in January. In this case, they kind of don't follow the same rules and guidelines as suggested. But in this case, they're going to assume that in January, they're going to start depreciating it. So that means at the end of the year, you need to depreciate it for 1 full year. Sorry, from January all the way to December. Now, here's the rule of thumb here is that in the accounting section, you do get to pick and choose what kind of depreciation method you want to use to go ahead and devalue your fixed asset, right? In this case, the book is just going to tell you to just do the most simplest type of depreciation, which is going to be straight line, okay? Where you're going to depreciate the fixed asset evenly amongst its entire estimated useful life. So in this case, right, they do tell you that if the cargo cost you $30,000, right, its estimated useful life was 5 years. That means you have 5 years to drive the cargo van. And the date that you placed in the service was January. And of course, with straight line, right, you're going to depreciate it. So in this case, you're going to divide the asset cost over, or divide it by its estimated useful life. So that means you're going to take $30,000, and since you're going to depreciate it evenly, since we're going to be using depreciation at the end of the year, December 31st, meaning you're gonna represent that you used the car for 1 whole year, which in this case, 1 whole year, if it has 5 years of useful life, you take that, divide it by the 30,000. That means it's gonna cost you $6,000 to depreciate every year. Okay. That means you're gonna take away $6,000 to represent that you used it for 1 whole year. So in this case, that is exactly what we're gonna do. Now that we figured out that the depreciation is going to be for $6,000, you're gonna go ahead and do your depreciation expense debit for $6,000, and then you're going to have a cargo van depreciation, which is your accumulated depreciation, and you're going to credit it for $6,000. Okay, so again, you do not directly take it off of the asset itself. That means in your books, it must remain as so, okay? But if you do not have depreciation or accumulated depreciation accounts in your QuickBooks, you will need to quick add them, okay? So here is what your instructions are in case you don't have them. So I'm going to go ahead and verify whether I have those accounts or not. Okay, so by going through my chart of accounts, I'm going to determine, do I have depreciation expense, yes or no? Okay, now in this case, because if you selected when you had the fixed asset, the assumption is QuickBooks should have already generated that account for you. Okay, so I type in depreciation, and here is the accumulated depreciation and the depreciation expense. So like I mentioned, because the fact that when we did our first entry, which is to acquire a fixed asset, the automatic assumption is QuickBooks should automatically create the depreciation expense and the accumulated depreciation accounts for you automatically. So in this case, yes, I do have them. So therefore, I can go ahead and create my general journal entry to go ahead and enter in my journal entry. So again, December 31st. Okay, adjustment entry. This is going to be relative. Okay, so in this case, like we mentioned, we figured out what the math is with depreciation. So in this case, I'm going to have depreciation expense. So here's my first one, depreciation expense for $6,000. And that's going to be credited to the accumulated, which is a contra asset account. This is where if you put your assets all together, it will automatically deduct it from it, and it will give you your fair market value, okay? Or your book value, excuse me. But in this case, that's going to be a separate table for another day, okay? So it says accumulated amortization, accumulated depreciation. okay, for fixed assets. Okay. And once again, it's going to be credited for $6,000. And what you're going to do here is depreciate cargo van. Okay. Now, if you want to create a separate sub account under there for specifically the cargo van, you can do it. You can go ahead and do so. It's not necessary because, again, you want to try to not have as many accounts because you're only limited to 250 accounts. So you do want to be careful with that. Location, once again, we said it was for both of the stores. Okay. And that will affect both of the stores. So overhead. Okay. And then once everything looks good, I can go ahead and save and close. Okay. So therefore, on your chart of accounts, if you go ahead and take a look, you could go ahead and scroll down to fixed assets and you'd be able to see fixed assets, and then the accumulated depreciation is right there. Okay. So if you actually run your trial balance here, okay, it should show your fixed assets and the total depreciation. It should show you your book value for this. Okay. All right. Okay. So that's depreciation. Once again, that's just to represent one of those examples that you have to do as an end of the year adjustment for having fixed assets. Okay. All right. So I am going to stop here for today. So when tomorrow we'll pick up, we will go over journal reports and the rest of chapter 11 in regards to closing out the books. Okay. All right.